Good morning and welcome to the Killik and Co market update. Markets have been a little bit weaker this week following a very strong November. The reason for the weakness is the energy sector. Oil prices have come down recently and therefore energy stocks have come down as well. Here's a 5-year chart for WTI crude, which is the benchmark for US oil. The price follows a very similar pattern to Brent crude, which is the benchmark used by the majority of the rest of the world. This week, the price for WTI has dropped to below $70 per barrel. We've been comparing the overall S&P 500 index to the integrated oil and gas segment of the S&P 500 index. On a 10-year basis, the wider index, shown in the green, is far ahead. This is on a total return basis, including all the dividends. On a 5-year basis, the performances are pretty similar, largely because oil prices and oil shares picked up following Russia's invasion of Ukraine. And finally, here's the 1-year chart. You can see that very obvious divergence between the two indices over the last 3 months, as the oil sector has moved sharply lower. The reason for the falling oil price is a big increase in oil production from the US. While OPEC+, led by Saudi Arabia, has been trying to limit oil production to keep prices high, the US has been doing the opposite, and the high level of supply has pushed prices lower. Here's US oil production since 1920. There's been a huge increase during the last decade, and this week production hit a record high of 13.2 million barrels per day. And this is not necessarily in accordance with America's plans to reduce its carbon emissions, and this will likely be a topic of conversation at the COP28 UN Climate Change Conference this week, which is still ongoing. Another commodity in focus this week has been gold, which has been trading above $2,000 per ounce for the last couple of weeks, and there are several possible reasons for this. Gold is viewed by some as a safe haven investment. Here's a 2-year chart. You can see that gold moved higher in early 2022 when Russia invaded Ukraine, and it's possible that some investors have bought in recently due to fears about unrest in the Middle East. Another reason is lower interest rate expectations. Gold does not pay any income, and therefore when interest rates are rising, gold seems relatively less attractive. When interest rates are expected to fall, as they are at the moment, that could make gold seem more attractive. The final reason is currency. Gold trades in dollars, and the dollar has weakened recently because of expectations that US interest rates are going to fall. When the dollar is lower, gold seems cheaper, and that could make it seem more attractive, and that could have pushed the price up. And lastly, UK companies remain out of favour, and we have looked at this a couple of times recently in this video. Here's a chart showing the UK's FTSE 100 index versus the FTSE small cap index since the start of 2021. You can see the small cap index has significantly underperformed. Further demonstrating that UK smaller companies are out of favour, this chart shows the extent to which UK-listed investment trusts that focus on small and mid-cap companies in the UK are trading at a discount. You can see that the average discount has widened significantly since late 2021, so the average discount is now around 14%. That means you can invest 86p in this sort of investment trust and get £1 worth of assets, a 14% discount. We've recently published some new research into this area, so do give us a call if you'd like to talk about that in a bit more detail. Moving on to have a look at next week, it's still very quiet as we approach Christmas, and there are no companies on the Killik covered list scheduled to report. So have a great weekend, and we look forward to seeing you next Friday.